The S&P 500 is once again bouncing near all-time highs. Depending on when you're watching this, we may be hitting an all-time high today. But the question for investors is whether or not these all-time highs are really buy signs and whether the market is moving higher. Now, one thing we know is that long-term, the stock market is likely going to move higher because that's just the way markets and capitalism work. Money flows to where it can most effectively be allocated, and gains often accumulate to some of the biggest companies in the world. So this is why the stock market continues to go higher and higher decade after decade. But over shorter periods of time, the stock market can fall pretty significantly. So now that we are hitting those highs, I think it's worth looking at where the market is today, what's driving the market, what the valuation looks like, and whether or not we should be maybe thinking a little bit differently than the market overall. That's what I'm going to dig into today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First of all, let's just look at the S&P 500 and the long-term chart, because I think this is really astounding. This is the S&P 500 chart on Google Finance. You can see that over the past 5 days, we've been bouncing near this all-time 52-week high of 5,341.88. Right now, we're off that just a little bit, but still near those all-time highs. But if you zoom back, phenomenal year for the market, 25.6%. Over the past 5 years, 91.9%. And go back to this max chart here. In 1984, the S&P 500 index was at 153, now at over 5,000. So just phenomenal returns for long-term investors. This is why I focus on investing in the stock market, investing in companies that can compound over long periods of time, because that's exactly what the stock market does. But let's put some more data to this, because the market's valuation does ebb and flow over time. This is the first chart I want to show. This is the S&P 500's price to earnings multiple. And this goes back to the 1980s, but you can see that we are at not the peak, because a lot of these peaks that you see in 2001, 2002, in 2009, that's because the E in price to earnings dropped during those recessions. Same thing can be said for this short period of time in 2020 and early 2021. That was when earnings were down a little bit, the market was up, so the price to earnings multiple jumped. But in normal economic times, a 25 price to earnings multiple is actually pretty high. In the early 2010s, the multiple was more like 15. The same can be said for the mid 1990s. And even in the late 2000s, you were looking at a price to earnings multiple for the S&P 500 of more like 15 to 20. So why is the multiple so high? Well, let's look at what the index is actually made up of. The S&P 500 is what's called a market cap weighted index. That means that the weight on the portfolio depends on the market cap of a company. If you go all the way down here to number 500, Mohawk Industries, very, very, very small impact on the S&P 500 overall, just 0.01% of the overall index. But go up to the top and you have a huge weighting to companies like Microsoft, Nvidia, Apple, Amazon, Meta Platforms, Alphabet, which is actually 2 stocks, so that should be number 4 on the list. So just those companies right there, those 6 companies account for over 25%, nearly 30% of the weight of the S&P 500 index. So when these companies do well, as in particular Nvidia has over the past year, it's going to pull the entire market higher. But let's look at some data behind these stocks, because this may actually tell us a lot about how the S&P 500 index overall is priced from a PE multiple perspective. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is a chart showing the price to earnings multiple of each of the 6 companies that I talked about earlier. You can see that Microsoft is trading for 37 times earnings. Nvidia is leading the pack here at 67 times earnings. Apple a little bit higher than the market overall, 29.9. Amazon at 51. And then Meta and Google are at about 27 and a half. So each of these 6 companies are trading for a price to earnings multiple higher than the market. This is a huge reason that the market is not only very expensive, but that the market has actually done really well. These stocks are up in large part because the revenues are still growing, their earnings are still growing, and most of these companies have an impact from artificial intelligence. That's kind of the one big thing that's driving the market right now is artificial intelligence, the demand that NVIDIA has for its own chips. If you start to look at things like retail, we're starting to see negative comparable sales for a lot of retail companies. You're starting to see discounting at grocery stores. American Airlines came out today and said, hey, you know what? Our guidance is going to be lower than we thought it was even just a month ago because demand for airline tickets not where they thought it was going to be. There's a lot of holes in the economy overall, but the market is being held up by these 6 stocks. And so I think that's really important to keep in mind when you're looking at the S&P 500 overall. There's typically, where we are today in the market, there's really between 5 and 10 stocks that are going to drive the market overall. The other 495 stocks may be phenomenal values. They may be trading for price to earnings multiples under 10. They may pay great dividends, but they're not going to drive the market overall. These companies are. So I think that's really important to keep in mind. So what am I doing about this as the price to earnings multiple for the market overall looks fairly high? It looks like a lot of these companies in the tech space are trading for very, very high earnings multiples. That's despite slowing growth in certain areas. So how am I reacting to this? Well, what I am doing is I'm looking for companies that can withstand any sort of slowdown. I talked earlier about question marks coming up about the economy. Is inflation going to start having a negative impact? Are people going to start shifting, spending their money from buying and renovating houses and buying cars to having to spend more money on groceries? That's exactly what we've seen. Now, we haven't seen that in the reaction from the stock market, but we've seen that in the economy. So I'm looking at companies that have really strong balance sheets, a lot of cash on the balance sheets. I'm looking for companies that have price to earnings multiples that are under 15 in a lot of cases. That's where I'm seeing asymmetric opportunities. I don't see the same opportunities with companies that are very, very expensive and that are leading the S&P 500 to this very expensive territory, because it's very possible that the PE ratio of the S&P 500 goes from 25 where it is today to something more like 15 where it was just a decade ago. That would not be out of the question. It would not be out of the ordinary for the market, especially if we have any sort of downturn or recession in the economy, which is very possible in the next few years. We haven't had a normal recession in about 15 years. So this has all made me a little bit more cautious about where I'm investing money right now, the opportunities that I'm seeing in the market. I'm not seeing them in a lot of the companies that are driving the S&P 500 today. In fact, I'm selling some of these stocks and buying what I view to be more valuable opportunities with higher upside in the future. But what do you think about where the S&P 500 is today? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.